You just said you expect growth to pick up now toward the end of the year. I'm curious about your forecast for next year, because the Fed is about to start tapering its emergency stimulus and could look ahead toward interest rate hikes next year at the same time where a lot of that front-end loaded fiscal stimulus is wearing off and a lot of the reopening momentum is going to wear off. So what does that add up to for next year?
Well, it's true that some of the fiscal stimulus will wear off. There'll be less fiscal stimulus next year for sure. But households have amassed a lot of saving. Wealth is increased. They've stashed away some of the income that they earned and didn't spend during the pandemic. And I expect consumer spending and investment spending to remain quite healthy. And, of course, the Federal Reserve is also, while focusing on inflation, wants to achieve full employment. While GDP has now surpassed its pre-pandemic peak, we're still about 5 million jobs below the pre-pandemic level. And while due to retirements, labor supply may not go back to its previous level, I think as the pandemic eases and concerns about health diminish, people will go back to work, labor force participation will improve, and, I expect unemployment to fall further and labor force participation to rise again.
Have you stopped using the T word, the transitory word, which we don't hear as much from Fed Chair Powell and some of the other Fed members? Are you still using it?
Well, I think it's still fair to use it in the sense that even if it doesn't mean a month or two, it means a little bit longer than that. I think it conveys that the pressures that we're seeing are related to a unique shock to the economy. And as the United States recovers and as vaccinations proceed globally and the global economic activity revives, that pricing pressures will ease. Monthly inflation rates have already come down considerably from where they were just 4 or 5 months ago. And that process is also continuing. Year over year, inflation rates remain high and will for some time, simply because of what's already happened in the first months of the year. But monthly rates, I believe, will come down, and in the second half of the year, I think we'll see a return to levels close to 2%.